So let me review the topic. Now, how do you compute what we call the earnings per share? First, I hope you know that there are different types of EPS. There are two types of earnings per share. One is what we call the basic earnings per share. That's one type of earnings per share you may be told to calculate. And number two is what we call the diluted earnings per share. So those are the two types of earnings per share that the examiner may ask you to compute. So let's discuss how do you calculate each of them. The first one is what we are calling the basic earnings per share. How do you get the basic earnings per share? Now listen, even the term itself, earnings per share, is telling you something. When you're told to compute the earnings per share, what do? Obvious, you are supposed to take the earnings that are attributable to the ordinary shareholders. Take the earnings attributable to the ordinary shareholders, and we are asking ourselves how much are the earnings per share. So in simple, you normally take what we call the earnings that are attributable to the ordinary shareholders. You divide that by what we can call the number of shares. You divide by the number of shares. That gives you what we are calling in simple earnings per share. But at this level, you know we don't just divide the earnings by the number of shares. You know we normally divide that by what we call the weighted average. We normally divide that by the weighted average number of ordinary shares. We divide that by the weighted average number of ordinary shares. The other question is, when you are given an income statement, how do you identify the earnings that are attributable to the ordinary shareholders? When you're given an income statement, because in an exam sometimes you're given an income statement of a company, so it's your responsibility to determine the earnings attributable to the ordinary shareholders. Let me illustrate. Once a company prepares an income statement, they normally get what we call the profit after tax. Let me assume that for purpose of illustration, this company got a profit after tax of, let's say, 10 million. Then it is this profit that is normally distributed. It is this profit that is normally distributed to the shareholders. So if your company, for example, has different types of shareholders, both of the category or all the category of shareholders are entitled to this profit. After you have paid everything else, whatever is the profit whatever is the profit after tax, that is the profit that should be distributed to the shareholders. Assuming your company had both ordinary shareholders and preference shareholders. So the examiner might come and tell you less dividends. One form of dividend could be, let me just call it less preference dividend. Preference dividend, let me assume 1 million. Then you are also given ordinary dividend. Ordinary dividend, let me assume 3 million. So that leaves you with what you are getting here as 6 million. So the question is now, listen, we are trying to compute the earnings per share that is attributable to the ordinary shareholders. So let me ask you, if you are given an income statement of this nature, how much would you say is the earnings that are attributable to the ordinary shareholders? Somebody chat. How much? If you are given an income statement of this nature and you are told to compute the earnings per share, what would you use as the earnings that are attributable to the ordinary shareholders? How much? Somebody chat very fast. How much are the earnings attributable to the ordinary shareholders from this income statement? How much are the earnings attributable to the ordinary shareholders? Somebody chat. If you are given an income statement of this nature, we want to take the earnings, we divide that by the weighted average number of shares. But the question is, now we want to know how much are the earnings. I've told you, listen, I've told you this profit after tax is the profit that is belonging to the ordinary shareholders. The profit that belongs to the shareholders. Our company has both ordinary shareholders and preference shareholders. And so we are looking for how much are the earnings that are attributable to the ordinary shareholders. Good. Somebody has given me the correct answer. Now listen. It means, listen carefully, this profit after tax of 10 million belongs to both ordinary shareholders and preference shareholders. Listen carefully. You also know that another characteristic or a characteristic of preference shares is that they normally earn a fixed return. Preference shareholders normally earn a fixed return every year. So maybe your company has a 10% preference share capital worth 10 million. So every year, these preference shareholders are entitled to a dividend of 1 million. 10% of 10 million. 10% of 10 million. They are entitled to a dividend of 1 million every year. So it does not matter what was the profit after tax of this company. If next year you make a profit of 15 million, we shall still give them a dividend of 1 million. So it means therefore, out of the 10 million, the profit that is attributable to the preference shareholders, the profit out of the 10 million, the profit that is attributable to the ordinary shareholders is 1 million. That leaves me with the balance of 9 million to be obvious what is attributable to the ordinary shareholders. So whether your company has paid the ordinary shareholders everything of the 9 million as dividend, or the company has retained everything of the 9 million as dividend, it does not matter. That is what is attributable to them. Whether the company paid them everything of the 9 million or they retained everything of the 9 million. From this illustration, they only paid them 6 million. They only, paid them 4 million. They only paid them 3 million and the company retained for them the other 6 million. Otherwise, the profit that is attributable to the ordinary shareholders is 9 million. So to get the earnings attributable to the ordinary shareholders, we are going to be taking what we are calling net profit after tax and you minus what we call the preference dividend. So we are saying, in other words, to get the earnings per share, the numerator now becomes profit after tax and you minus what we are calling preference dividend. Then from there now you will divide that by what we are calling the weighted average number of ordinary shares. So this is the formula we shall be using to compute the earnings per share. You take the earnings attributable to the ordinary shareholders as the numerator, and that numerator is determined by taking the profit after tax. We can even just call it profit after tax, and you minus whatever is the preference dividend. Whatever is the preference dividend, that will give you the earnings attributable to the ordinary shareholders. We divide that by what we call the weighted average number of shares, which we shall discuss in details how to compute the weighted average number of shares. So I want to believe now you are okay with how to compute the numerator. We have said to get the earnings per share, you take the earnings attributable to the ordinary shareholders. I have said you divide that by the weighted average number of shares. But how do you get the earnings attributable to the ordinary shareholders? I've said you get it by taking the profit after tax, you less preference dividend, whatever the preference dividend for the company. Good. Then you now divide that by the weighted average number of shares. Now listen, just for the sake of it, sometimes the examiner does not give you this income statement. Listen carefully. Sometimes the examiner does not give you this income statement. But from the balance sheet that the examiner will give you, a section of the balance sheet, which we normally call the capital structure of the company. From the capital structure of the company, you realize they have a 10% preference share capital of 10 million. So even if the examiner has not given you the income statement, so long as the company has preference share capital, the preference dividend should be deducted. I hope you're getting that point, that even if the examiner has not given you the income statement, so long as the company has preference share capital, their preference dividend should be deducted from the profit after tax. So that's a point one should not forget, that preference dividend should be deducted, whether it is given in the income statement or it's not given. We are saying so long as the company has preference share capital, you should deduct their preference dividend. Good. So I want to believe the numerator has no problem. Normally the complications do come with the denominator. We are not just dividing by the number of shares. We are dividing by something we are calling the weighted average number of shares. And I want to remind you, how do you compute what we call the weighted average number of shares? What is it that can affect the number of shares? Good. So let me discuss or remind you how the weighted average number of shares is computed under different circumstances. What makes the number of shares to change? Listen. Now we are discussing the denominator now. Suppose your company began the year with 2 million shares. Then on 1st of July this year, your company decided to issue 1 million shares at full market price, and they are fully paid. One share was issued at a market price of 20 and it was paid fully. How do you compute the weighted average number of shares? As much as it's true, listen, yes, we began the year with 2 million. We have issued another 1 million shares on 1st of July this year. It's true, in the register of shareholders, we have 3 million shares in the register. But we used the 3 million as our weighted average number of shares. The answer is no. We shall look at the rules for how to compute the weighted average number of shares when shares are issued at full market price and they are fully paid. Another circumstance that can affect the computation of the weighted average number of shares is when, for example, again, on 1st of July, your company issued 1 million shares at full market price, but partly paid. Let me explain. For example, your company issued 1 million shares at a market price of 20, but come the end of the year, the shareholders have only paid us 15 shillings out of the 20. How do you compute the weighted average number of shares for purpose of earnings per share? Good. That's another item we shall discuss. Again, what if on 1st of July, your company issued 1 million shares as bonus shares? What are the rules on how to use bonus shares to compute what we are calling the weighted average number of shares? So you need to know the rules for each of these items that can affect the number of shares. Of course, assuming again on 1st of July, your company issued another 1 million shares as a result of a stock option. Your company issued 1 million shares as a result of a stock option. How do you use them to compute the weighted average number of shares? What are the rules for stock options when it comes to computation of the earnings per share? I want to believe that you know what are stock options. Of course, stock options are, but first let me explain. Bonus shares, these are extra shares given to existing shareholders. Bonus shares are extra shares given to existing shareholders free of charge. Stock options is a privilege. Stock option is a privilege given to employees of your company, given to employees of the company to purchase shares at a price below the market price. Stock option is a privilege that's normally given to the employees of the company for them to buy shares at a price below the market price. So we shall discuss how do we use them to compute the weighted average number of shares. Another circumstance, suppose on 1st of July again, your company issued 1 million shares as a result of a rights issue. How do you compute the weighted average number of shares? Of course, a rights issue again is a privilege. I hope you know a rights issue is a privilege given to existing shareholders to buy, given to the existing shareholders to buy extra shares at a price below the market price. So they are given the privilege. Who? The existing shareholders, not the employees now. The existing shareholders, they are given a privilege to buy extra shares at a price below the market price. How do you use them? To compute the weighted average number of shares. Next, what if on 1st of July, your company issued 1 million shares as a result of a share split? As a result of a share split, meaning they did a share split on 1st of July, and as a result of a share split, the company issued an extra 1 million shares. How do you use them to compute the weighted average number of shares? That's something else we need to remind ourselves. Next, what if on 1st of July, your company issued 1 million shares as a result of conversion of debentures / preference shares? Listen, many years ago, your company had issued convertible debentures, or your company had issued convertible preference shares. These debenture holders had not exercised that right. But come this year, 1st July, they decided to exercise the right and converted their debentures or preference shares into ordinary shares. And as a company, we issued them 1 million shares as a result of their conversion. How do you use them to compute the weighted average number of shares? What are the rules? Good. We shall remind ourselves. Next one. What if again on 1st of July, your company issued 1 million shares as a payment of the purchase consideration? As a payment of the purchase consideration in acquisition of a business. Maybe you know that when you as a company are buying another business, the purchase consideration can be settled by issuing shares. So if your company issued shares as a payment of the purchase consideration in a business acquisition, just like you have done the topic of reconstruction, and specifically the area of external reconstruction. You know that in external reconstruction, a company can buy another company, and the company buying the other company must pay the purchase consideration to buy the other business. So suppose they paid in terms of shares to acquire the other business. How do you use those shares to compute the weighted average number of shares? Good. So I want to believe that you can still remember the rules of how to use these different items in the computation of the weighted average number of shares. Once you understand the rules, or you can remember the rules, then that means no question should defeat you, because actually the topic of earnings per share is normally based on rules. If you can remember the rules of each of the items, then you'll have no problem computing the weighted average number of shares. So let me start by reminding you how to use each of them, or what are the rules for each of them in the computation of the weighted average number of shares. Good. We start when shares are issued at full market price and fully paid. How do you use them? I want to believe you can still remember. We have just said, let us assume that our company began the year with 2 million shares. On 1st of July, our company issued 1 million shares at a market price of 20, and by the end of the year, everybody had paid their 20. What would become the weighted average number of shares? How do you use the 1 million? Do you just take the 2 million beginning shares plus the 1 million to become the weighted? The answer is no. Listen, there is only one simple rule for this. When shares are issued at full market price and they are fully paid, the accounting standard says those shares that are issued must be weighted. Must be weighted on time basis. On time basis. That is the only simple rule that you have to remember when shares are issued at full market price. We are saying they should be weighted. Listen, We issued these shares on 1st of July, 1 million shares at a market price of 20. Listen. So these shareholders brought in 20 million shillings on 1st of July. It is obvious their money will finance me as a company. Their money will finance us for only 6 months. So the question is, why should we give them earnings for the full year and yet their money only financed me for 6 months? That's why we are saying when shares are issued at full market price and they are fully paid, they should be weighted on time basis. Good. Meaning you will take your 2 million shares that were there by the beginning of the year plus your 1 million shares that were issued on 1st of July. But don't forget, these shares or the money only finance me for 6 months. So you multiply that 1 million, not the 2 million, the 1 million is the one we are saying must be weighted on time basis. Meaning the 1 million shares that were issued must be weighted by multiplying it by a time adjustment factor. We call it a time adjustment factor, which is of course 6/12. 6/12. So it's obvious, therefore, this will become something like 2 million plus 500. So when you are computing the earnings per share for this company, the weighted average number of shares will be 2.5 million. As much as it's true in the register we have 3 million shares, in the computation of the EPS we don't use 3 million, we use 2.5 million. So that is the only rule you need to remember when it comes to shares being issued at full market price. Okay, we are saying when shares are issued at full market price, they must be weighted on time basis. That's all. Good. So I can now move to the second one. I want to remind you what are the rules. Now, again, when shares are issued at full market price, but partly paid. Let us assume again, your company began the year with 2 million shares. On 1st of July, 1 million shares were issued at a market price of 20, but come the end of the year, these guys had only paid me 15. How do we use these 1 million shares to calculate the weighted average number of shares? I don't know whether you can give me the keyword. When shares are issued at full market price, but they are partly paid. It is obvious they will pay you the balance in future. There is a balance of 5 shillings per share, which these guys will pay you in the future. We are not issuing the shares at a discount, no. We are issuing them at a market price of 20, but they have so far paid me 15. The other balance of 5 shillings per share, they will still pay me, but later. Okay? So what is the rule when it comes to shares being issued at full market price and partly paid? Somebody chat. How do we use them? Just give me 1 or 2 words. I'll be able to know. You chat 1 or 2 words. I'll be able to know. What is the rule when shares are issued at full market price and they are partly paid? How do we use them for computation of the weighted average number of shares? Somebody chat, give me 1 or 2 words, I'll be able to know. One or 2 words, I'll be able to know. How do we use them for computation of the weighted average number of shares? What's the rule? I'm waiting. What's the rule? When shares are issued at full market price, only use those that are considered to be fully paid. Thank you, Maureen. Thank you, Maureen. Correct. That's correct, Maureen. In other words, listen. Listen carefully. We are saying, yes, we issued 1 million shares, but you will ask yourself this question. How many out of the 1 million shares are considered to be fully paid? How many out of the 1 million are considered to be fully paid. We issued yes 1 million. They have so far paid me 15 shillings per share. So it means they have only paid me 15 million shillings. But if they were to use the 15 million, listen to this now, if they were to use the 15 million shillings to go to the stock market, they will not be allowed to pay partly. They will be required to pay full the 20 shillings. So if they were to use their 15 million and buy one share at a market price of 20 in the stock market, they can't buy 1 million shares. As a company, yes, we have issued 1 million shares at a market price of 20, but come the end of the year, we allowed them to be paying in installments. That means they have paid me 15. So, but for purpose of the earnings per share, we ask ourselves, how many out of the 1 million shares are considered to be fully paid? It will mean you take the amount received from the issue of shares, you divide that by the market price per share. That looks like about 750,000. So it is this 750,000 shares that are considered to be fully paid out of the 1 million. Listen also. Listen carefully. Another way to argue is this. We normally say, whenever a company pays dividends, listen, whenever a company pays dividend, we only pay dividend to fully paid shares. We don't pay dividends as a company. We normally don't pay dividend to partly paid shares. We only pay dividends to fully paid shares. So you will ask yourself, because we never pay dividends to partly paid shares, out of the 1 million, how many shares will participate in dividend? Because we don't pay dividend to partly paid. So we shall only pay dividends to the shares that are considered to be fully paid, which will be how many? This 750. So in other words, we are saying to compute the weighted average number of shares when shares are issued at full market price and they are partly paid, one way to argue that is to say you only consider them to the extent that they are fully paid, like somebody gave us the answer. You can also say only to the extent. We only use the 1 million shares only to the extent that they will participate in dividend. Because you normally don't pay dividends to partly paid shares, we only pay dividends to fully paid shares. So out of the 1 million, how many are fully paid so that they get the dividend? It is that 750. It is that 750. Good. So we are saying, in other words now, listen, to compute the weighted average number of shares, we are saying only to the extent that they are fully paid. That is the key word. Meaning, you will now come and take 2 million shares that were there by the beginning of the year, plus the 750,000. Listen again. Those 750,000 is the one to be fully paid. Remember, their money did not come into the company in January. The money of 15 million did not come in January. The money came in July. So again, this 15 million that they gave us in July did not finance me for the full year. It only financed me for 6 months. So we are again saying, as much as it's true, 750,000 are considered to be fully paid. But again, why should I give you earnings for the full year when your money did not finance me for the full year? Your money only financed me for 6 months. So this 750 should be weighted by, again, multiplying it by 6/12. Had we issued 1 million shares in January at 20, but come the end of the year, they had only paid me 15, then the 750, we shall not multiply it by 6/12. Why? Because I would be arguing by saying the money came in January and therefore it financed me for the full year. But here is a case where we are assuming the shares were issued in between the year. And if they are issued in between the year, those shares which are considered to be fully paid, again, we are saying they must be weighted. So if from the question you realize that the shares were issued in between the year, then they must be weighted. They must be weighted. I hope you are there. I hope you are there with the second one. So what is the key point? We have said when shares are issued at full market price and they are partly paid, only consider them to the extent that they are fully paid. Only consider them. Which one? The shares. Only to the extent that they are fully paid. How do you determine them? You take the amount received. You take the amount received from the issue of shares. You divide that by the market price per share. That will give you the number of shares to the extent that they are fully paid. Are you there? Good. Then once you receive, once you know now, find out when did the money come in. Did it finance me for 6 months, 2 months, 4 months? If it's 4 months, you multiply by 4 by 12. If it's finance you for the full year, maybe the shares were issued in January, fine, no problem. Good. I think I'm through now with the second item. Let me remind you the third one. Let me remind you the third one now. How to deal with what we are calling bonus shares. Shares issued as bonus. Shares issued as bonus. I've already told you what are bonus shares. I've told you these are shares given for free. So let us just say again, you began the year with 2 million. On 1st of July, your company issued 1 million shares for free. For free. For free. That means, listen, these guys did not bring any money to the company. These guys did not bring any money to the company on 1st of July. No. So you as a company, therefore, you can't tell them, oh, that your money did not finance me for the full year, so I'll multiply it by 6 over 12. No. They never brought anything for that 1 million shares. You just gave them for free. So the point is this. When shares are issued as bonus shares, when shares are issued as bonus shares, the point is they are not weighted. Not weighted on time basis. Not weighted on time basis. It does not matter whether you issued them in between the year or at the end of the year. No, you don't multiply that by 6 over 12, 9 over 12. No. Why? Because we have said no money came in, no new funds came into the business. Listen, and therefore, when a company issues bonus shares, those shares are assumed, listen, they are assumed to be issued as from the beginning of the year. They are assumed to be issued as from the beginning of the year. That's why we are not multiplying them by a time adjustment factor. No. So you just take your 2 million shares that were there by the beginning plus the 1 million bonus shares. That means your weighted average number of shares will be how much? 3 million. Your weighted average number of shares will be 3 million. So that's how we compute the weighted average number of shares when shares are issued as bonus shares. Now, there is another critical point. There is another critical point when it comes to bonus shares. What is that extra point? An important point. Listen. Because the shares are assumed to be issued at the beginning of the year, listen, the accounting standard says that the EPS of the previous year, should also be restated. For comparison purposes with the earnings for this year, you are required to restate the EPS of last year. For example, let us assume the earnings last year were 8 million. The number of shares last year were 2 million. So it's obvious your EPS last year was 4 shillings per share. Our earnings we are assuming were 8 million last year. The number of shares last year were 2 million. So your earnings per share was 4 shillings. But come this year, we issued another 1 million shares on 1st of July. We have said they are assumed to be issued as from the beginning of the year. And therefore, the accounting standard says, for comparison purposes, the EPS of the previous year should be restated. How do we restate it? It's obvious. You will take the earnings last year, which are 8 million. You now divide that by the number of shares last year, 2 million, plus the bonus shares in the current year. You take the number of shares last year, 2 million, plus the bonus shares in the current year, 1 million. That means you now divide that by 3 million. That will become the restated, we call it restated EPS, which looks like 2 point something, or let's assume, I don't know how much. Let me calculate and see how much it is for purpose of illustration, for purpose of just illustration. What would be the earnings per share? We are dividing 8 million divided by 3. That's about 2.66. Last year it was 4, but now it is a restated EPS. We call it restated EPS of 2.66. So those are the two, those are the two critical points when it comes to bonus shares. That when shares are issued as bonus, one, they are not weighted on time basis. Why? Because they are assumed to be issued at the beginning of the year. So you don't multiply them by the time adjustment factor. Point number 2, important, is that the EPS of the previous year should be restated for comparison purposes. How? By dividing the earnings of the previous year, by the number of shares in the previous year plus the bonus share element in the current year. In the current year, the bonus share element was 1 million. You add it to the previous years, and you get you get the number of shares for restating the EPS, which means the number of shares for restating the EPS now becomes 3 million. So that's how we restate the EPS of the previous year. So I want to believe you're okay now about that, the rule for bonus shares. Okay, let me now go to the fourth one. I've discussed 3 already. Critical items to remember when you are computing the weighted average number of shares. When shares are issued at full market price and they are fully paid, we have said they should be, when shares are issued at full market price and they are fully paid, they should be weighted on time basis. That was 1. Number 2, when shares are issued at full market price, they are partly paid. Only consider them to the extent that they are fully paid. Number 3, when shares are issued as bonus, they are never weighted on time basis because they are assumed to be issued from the beginning of the year. The other key point is the EPS of the previous year should be restated for comparison purposes. Good. We now go to the fourth item. And that is when shares are issued as a result of a stock option. How do you compute the weighted average number of shares when shares are issued as a result of a stock option? What is a stock option? I've already told you it's a privilege given to the employees to buy shares at a price below the market price. Good. Now listen. We began the year with 2 million shares. On 1st of July, the company gave the employees the privilege to buy 1 million shares at a price of 15 when the market price was 20. We are saying the market price is 20, but they were given the privilege of buying them at 15. How do we compute the weighted average number of shares? Let me just in fact ask you, Somebody take 1 minute and calculate for me the weighted average number of shares. Take a minute and say, we began the year with 2 million. We issued 1 million shares on 1st of July as a result of a stock option. Again, these shares were issued at a market price of 20. The market price is 20, but they were given a privilege to buy them at 15. How much how much shall we use as the weighted average number of shares? Maybe take a minute and calculate for me. Let me see now that we are revising. Now that we are revising, you should be able to remember the rule for stock option. So take a minute and calculate for me. What do you think we shall use as the weighted average? Somebody's getting 26.25. Somebody's getting 26.25. Somebody else. Somebody's getting 26.25. Somebody else. Now that we are revising. Somebody's getting 26.25. Somebody else. Now that you know the rules. I'm waiting for one more opinion. I'm waiting for one more opinion. Somebody called Gilbert has given me 26.25. Somebody called JM has given me 2.5. Which automatically tells you, you must remember the rule. You must remember the rule. You cannot just calculate without knowing the rule. You can see why we are talking of the rules are important. When shares are issued as a result of a stock option, what is the rule? One more opinion, let me hear. I'm waiting. We are revising. One more opinion. One person has got 2,625,000. Somebody else has given me 2.5 million. Let me hear one more opinion. Yes, one more opinion. One more opinion. Aha, 26.25, Paul. Sawa, two people are getting 26.25. So let me see. Now listen. When shares are issued when shares are issued as a result of a stock option, listen, you as a company, you are required to ask yourself, how many out of these 1 million shares are considered, listen, how many of them are considered to be issued at full market price? How many shares out of them are considered to be issued at full market price? And how many of the 1 million shares are considered to be issued for free as bonus? In other words, listen, whenever a company issues shares as a result of a stock option, then you as a company, you need to ask yourself, yes, listen, we issued 1 million shares, that's a fact. But these guys, don't forget, they brought only 15 million shillings to the company. If they were to use their 15 million to go to the stock market, they can't be allowed to buy them at a discount. No, they will only be allowed to buy them at 20 shillings. So their 15 million would only have been enough to buy how many shares? It's obvious, would have only been enough to buy 750,000 shares. So out of the 1 million, listen, out of the 1 million, 750,000 shares are considered to be issued at full market price. Listen, but we never gave 1 million shares. We never gave 750,000 shares. We gave 1 million. They brought 15 million. Listen, they brought 15 million, which is 1 million shares. times 15 shillings per share. They gave us only 15 million shillings, but we gave them 1 million. We should have given them 750,000 shares, but we never gave them 15,000 shares. No, we never gave them 750,000 shares. We gave them 1 million shares. So automatically, therefore, it means that as a company, there is another 250,000 shares which we are considering that we gave them for free. It's like we gave them for free. So when shares are issued as a result of a stock option, then the first thing you must do is to separate the 1 million shares. How many of them are deemed to be issued at full market price, and how many of them are deemed to be issued as bonus? To get the number of shares deemed to be issued at full market price, you divide the amount received from the stock option. You divide the amount received from the stock option by the market price per share. Our market price per share is 20, so that will give you the number of shares that are deemed to be issued at full market price. Then the difference between the number of shares issued, which is 1 million, subtract the ones issued at full market price 750. Those are the ones that are considered to be issued as bonus. Now listen. Having separated that way, listen carefully. Having separated that way, now you know the rule. You go back to the rule. What is the rule when shares are issued at full market price? What is the rule when shares are issued as bonus? We have already discussed. When shares are issued at full market price, that was the first item we said, they must be weighted on time basis. 2, we have said just a short while ago, when shares are issued as bonus, I said they are never weighted on time basis. Why? Because they are assumed to be issued at the beginning. That's what we said. Good. So how much is the weighted average number of shares? Let's now see. It will be 2 million that were there by the beginning of the year, plus the 750,000 shares that we issued at full market price. Listen, but don't forget, this 15 million that they gave us did not come into the company on 1st of January. It came into the company on 1st of July. So their money again did not finance me for the full year. Their money only financed me for 6 months. So I multiply that by 6/12. Then I come and say plus the bonus element of 250. The rule for bonus we have already agreed. The rule for bonus we have already agreed. They are never weighted. Bonus shares we have already said they are never weighted. Why? Because they are assumed to be issued at the beginning of the year. So this will be 2,000 plus 375 plus 250. It looks like somebody got it. That looks like 26. Is it 25? Yes. Good. At least some 2 people got it. Some 2 people got it. Paul and Gilbert got it. So JM, I hope you have seen where you went wrong. I think you just considered the time factor. You did not consider this as stock option. Okay? So what have we said? Listen, I'm not through yet. I've only said point number 1. When shares are issued as a result of a stock option, they are assumed. When shares are issued as a result of a stock option, some of those shares are deemed to be issued at full market price. Some are deemed to be issued as bonus. So you must separate. To get the number of shares deemed to be issued at full market price, we have said you divide the amount received from the stock option by the market price per share. Then I've said the difference between the number of shares issued, which is 1 million, and the number of shares issued as a result, for full market price, the difference is bonus. Then once you separate, you will go back to the rules. When shares are issued at full market price, they must be weighted. When shares are issued as bonus, they are never weighted. Good. Listen again. Don't forget, there's another rule for bonus. Because they are assumed to be issued at the start of the year, again, the EPS of the previous year, should be restated. for comparison purposes, because the bonus, not the 1 million, the bonus element 250 are assumed to be issued at the beginning, then the EPS of last year should be restated. I'm again assuming the earnings last year were 8 million. We divided by number of shares last year, 2 million. So the earnings per share last year was 4. But now we must restate it for comparison purposes. How? By dividing the earnings last year, 8 million, by the number, listen, by the number of shares last year, which is 2 million, plus the bonus share element in the stock option, plus the bonus share element in the stock option, which is 0.25 million, which is 250. So ideally, therefore, you are going to divide the 8 million from this illustration. You're going to divide the 8 million by 2.25 million. Because you took 2 million, you add the bonus element of 250, that gives you 2.25 million. Good. So I hope you now understand, or you can now remember the rule for stock options. That when shares are issued as a result of a stock option, they must be separated. How many of them are deemed to be issued at full market price? How many are deemed to be issued as bonus? Those issued at full market price must be weighted. Those issued as bonus are never weighted. They are never weighted. Okay? They are assumed to be issued at the beginning of the year. They are assumed to be issued at the beginning of the year. Good. Then I've said those issued as bonus, remember, they are assumed to be issued at the beginning, so the EPS of the previous year should also be done what? Be restated. How? By dividing the earnings of the previous year, dividing the earnings of the previous year by the number of shares in the previous year plus the bonus share element in the current year, plus the bonus share element in the current year. Good. So I hope you are together now. We can move on. I hope you are together now. We can move on. We now want to go to the next one, and that is what we call the rights issue. The rights issue. How do we use them to compute the weighted average number of shares when shares are issued as a result of a rights issue? Again, let me assume we began the year with 2 million shares. On 1st of July, we gave the privilege. Don't forget, we said it's also a privilege. It's a privilege given to existing shareholders. Given to existing shareholders to buy extra shares at a price below the market price. We issued 1 million shares. The market price was 20. We gave them existing shareholders the privilege of buying them at 15. What is the rule? How do we use stock options, rights issue, to compute the weighted average number of shares? Can I give you a minute again for you to calculate for me the weighted average number of shares? We gave the existing shareholders, not the employees. Employees, for them, we call it stock option. But when we are giving the privilege to existing shareholders, we call it a rights issue. So, can I give you a minute to calculate for me how many or the shares we shall use as the weighted average? I've explained the stock option, but don't forget, this is not a stock option, this is a rights issue. We are revising, so you should know the rules. You should know the rules. Yes. Somebody? Get 1 minute and calculate for me what shall we use as the weighted average. Take a minute and calculate for me what you think we shall use as the weighted average. Yes. What shall we use as the weighted average? hope you are still calculating. I hope you are still calculating. I'm waiting. What is the weighted average when... Okay. Let me put it a simple way. Now listen again. Listen, let me put it a simpler way so that you give me the answer faster. I'm not asking you the weighted average. The question is not clear. I want to reframe it. Let me reframe it so that I give you a simpler calculation. Listen. When shares are issued as a result of a rights issue, listen. When shares are issued as a result of a rights issue, just like stock options, again, you are required as a company to ask yourself how many of these shares are deemed to be issued at full market price and how many of them are deemed to be issued as bonus. Listen. When you are issuing shares as a result of a rights issue, those shares that are issued, some of them are deemed to be issued again at full market price, and some of them are deemed to be issued as bonus. But then, listen, which I want you to not give me there, to compute the number of shares deemed to be issued at full market price. Listen, you don't do like we did for bonus here, for stock options, sorry. We took 15 million amount received, we divided that by the market price to get this number of shares deemed to be issued at full market price. So I don't want you to give me now again 750 here. So give me those which are deemed to be issued at full market price. When it is a rights issue, you don't compute the loss issued at full market price the same way we computed for stock option. I've just reminded you so that you don't give me 750 down there. So give me those deemed to be issued at full market price. Now you can take a calculator and give me in a minute those deemed. John, I'm not asking for the weighted average. You are giving me 2 million or something. I've changed my question because somebody was saying it was not clear. So what I did, I reframed the question again and now asked a simpler one so that we finish by computing the weighted. But before we go to the weighted, I want you to tell me, out of the 1 million shares here, how many of them are deemed to be issued at full market price when it is a rights issue? How many out of the 1 million are deemed to be issued at full market price? Maureen is giving me 819. Gilbert is giving me 819. 819. I think 2 people are giving me 819. Somebody gave me 250. Okay, good. Let me see whether they are right. Now listen. Let's see whether they are right. Listen. When shares are issued as a result of a rights issue, listen, the first thing you must do is to calculate a price that we call the theoretical. You must calculate what we call the theoretical X right price. Listen, as a company, we began the year with 2 million shares. The market price was 20 before the rights issue. We issued another 1 million shares. Listen to this. We issued another 1 million shares to the market. Remember, we are issuing shares to the existing shareholders. So this must be a public company. So we are issuing another 1 million to the members of the public. No, to the existing shareholders in the public. Now listen. it is expected, you know this from the rule of supply and demand. Before we issued 1 million shares, the market price was 20. Now we are issuing another 1 million shares to the public. It is obvious we expect the price of the shares from 1st July to be affected, because we are increasing the supply of the shares on 1st of July in the market. Anybody can buy them now. We are giving the existing shareholders the privilege to buy an extra 1 million shares, not just the employees. Remember, the employees are within the company, but here it is the existing shareholders. They are given the privilege to buy extra shares. Now, I have said we are issuing another 1 million shares to the public. In other words, we are increasing the supply of the shares. You know, the rule of supply says the higher the supply, the lower the price. The higher the supply, the lower the price. So it is obvious we expect from 1st July, the price of the shares in the market now will no longer be 20. Before the rights issue, the market price was 20. We are increasing the supply of the shares in the market by another 1 million shares. We expect the price to come down. What is that price that is expected to prevail after the rights issue in the stock market? What is the price that is expected to prevail? Whatever price that is expected to prevail after the rights issue, that price is what we call the theoretical ex-right price. We call it the theoretical ex-right price. So theoretical ex-right price is the price that is expected to prevail after the rights issue. Having known that, now the question is, how do we calculate it? Listen. Before the rights issue, listen, don't. Before the rights issue, our company, before rights, our company had 2 million shares. The market price per share was 20 shillings. So it is obvious, therefore, before the rights issue, the market capitalization of our company, was how much? 40 million. I'm putting the figures in thousands. Before the rights issue, we had 2 million shares at a market price of 20. So the market capitalization of our company was 40 million. Then we issued another how many shares? 1 million shares as a result of a rights issue. So it means we issued them at 15 per share. So the shareholders, the existing shareholders, brought in another 15 million shillings as a result of buying those shares. So it means, listen, it means after the rights issue, the market capitalization of our company increased by another 15. So the market capitalization of the company after the rights issue will now be 55 million, but the number of shares after the rights issue will be 3 million. Now listen. So we are saying before the rights issue, the market capitalization of the company was 40 million. In other words, 2 million shares were fetching that market capitalization. We increased the supply of the shares in the market by another 1 million. We expect the price of the shares to come down. But before that, we are saying, but after the rights issue, the market capitalization of the company became 55 million. So 3 million shares, listen, 3 million shares after the rights issue are fetching a market capitalization of 55 million. So to get that theoretical X right price, we are taking the market capitalization of the company after the rights issue, which is 55 million. We divide that by the number of shares after the rights issue. So what becomes the price that is expected to prevail? Let me calculate it. 55,000, we divide that by 3,000. So we expect the price per share in the market to be 18.3. Remember, before the rise it was 20. We have increased the supply of the shares. We expect the price to come down to how much? To now 18.3. Good. Now listen. Once you get that expected price, then you argue by saying, these guys who bought the 1 million shares, they brought in 15 million shillings to the market, to us. If they were to use their 15 million shillings to go to the stock market, they will not buy one share at 15. Don't forget, we gave them the privilege of buying them at 15. But if they were to use their 15 million to go to the stock market, now they will find one share being sold at 18.3. So their 15 million again would be enough to buy how many shares? If the price that is expected to prevail in the market is 18.3, I take that 15 million, I divide that by 18.3. That gives me 672 to the nearest whole number. 672. Good. I think some 2 people got it correct. Some 2 people got that answer, that the the number of shares deemed to be issued at full market price was 819. Good. So I come back here now and say those deemed to be issued at full market price here are 819,672, which automatically leaves me with the balance to be the number of shares deemed to be issued as bonus. So if I minus from 1 million, that looks like 100,000. Let me just minus from 1 million. Let me see how much it is. 180, sorry. It's about 180. Those deemed to be issued as bonus are 180, 328. Good. 328 to the nearest whole number. Good. So that's how you separate. Now listen. That's how you separate. I've said, listen carefully. When shares are deemed to be issued as a result of a rights issue, some of those shares are deemed to be issued at full market price, and some are deemed to be issued as bonus. I have said the first thing to do is to compute the price that is expected to prevail after the rights issue. The price that is expected to prevail after the rights issue, we are calling it the theoretical X right price. Okay? Then I've said, how do we compute the theoretical X right price? I have said, you divide the market capitalization of the company after the rights issue. You divide the market capitalization after the rights issue by the number of shares after the rights issue. Before the rights issue, we had 2 million shares at a market price of 20. That gave me a market capitalization of 40 million. We issued another 1 million shares at a privilege price of 15. So these shareholders brought in an extra 15 million. So the market capitalization of the company went up by another 15. So it came to 55. But after the rights issue, the market number of shares will be 3 million. So we are saying 3 million shares are in the market. They are fetching a market capitalization of 55 million. What is the price that is expected to prevail? So we take the market capitalization after the rights issue, divide by the number of shares after the rights issue. That will give us the theoretical X right price. Then I've said, to get those shares deemed to be issued at full market price, we are saying you divide the amount received from the stock option, from the rights issue, divide the amount received from the rights issue by the theoretical X right price. That will give you the number of shares deemed to be issued at full market price. Then again, the difference between the number of shares deemed to be issued at full market price and the number of shares deemed to be issued as a result of a rights issue, which was 1 million. The difference is what we are calling bonus. Good. Now listen, once you know that, again, you know the rules. When shares are issued as a result of when shares are issued at a full market price, they must be weighted. When shares are issued as bonus, they are never weighted. So what do? You just come and can now compute the weighted average number of shares. It will be 2 million, which were there by the beginning, plus 819,672 times. Don't forget again, the 15 million they paid us came in between the year. So their money did not finance me for the full year. Their money only financed me for 6 months. So I multiply that by 6/12 plus the bonus element we have seen. It's 180,328. 180,328. This is bonus and it's never weighted. Good. So whatever you will get here becomes the weighted average number of shares. Becomes the weighted average number of shares. Good. Now listen again. Just like stock option. Listen. Just like stock option, where there was a bonus element, even here, there's a bonus element. And we have already said, when there's a bonus element, the EPS of the previous year should be restated. So whenever the bonus is mentioned, you must remember to restate the EPS of last year. Now listen carefully. Again, just as a reminder, how do you restate the EPS of last year? Do I do it the same way I did for bonus, for stock options, sorry? Do I do it the same way I did for stock options here? You remember, for stock options, I took the earnings last year, 8 million. I divided that by the number of shares last year, 2 million, plus the bonus in the current year, 250. I got it 2.25. That's what I did for stock option. Listen, but for rights issue, you don't do the same. Listen carefully now. The earnings last year were 8 million. Number of shares last year were 2 million. Our EPS last year was 4 shillings. But now we are saying that EPS of the previous year should be restated for comparison purposes. Now listen. So to compute the restated EPS, listen carefully. To compute the restated EPS, you don't do like you did for stock option. No. What do? You now take the earnings of the previous year, the EPS of the previous year, which is 4. You multiply that EPS of the previous year. Listen, you multiply the EPS of the previous year by a factor. By a factor. What is that factor? You multiply that by what we call the theoretical X right price. You divide that by the actual right price. That's what we do. You take the EPS of the previous year and you multiply it by a factor. What is that factor? The theoretical X right price. Divide that by the actual right price. From our illustration, this is 4 times. The theoretical X right price we have already seen is 18.3. Divide that by the actual right price, which was 20. Good. Whatever you will get, that will be what will become the restated EPS. Let me see how much. Let me calculate it. It was 4 times 18.3. I divide that by 20. I'm getting something like 3.66. So it was 4 shillings last year, but now the restated one comes to 3.66. Okay, good. So now you know how to compute the restated EPS if we had a rights issue. I have said you multiply the EPS of the previous year by a factor. That is the theoretical X right price. You divide that by the actual right price. Good. I think I'm through now. with the rights issue. What I want you to remember, is the difference in the computation for stock option and the rights issue. Most students forget the rights issue way and compute a question on the rights issue as if it was a stock option. No. As much as it's true for both, you must ask yourself, how many shares out of the 1 million issued are deemed to be issued at full market price, and how many are deemed to be issued as bonus? That's a fact in both. But how to separate is different. I have said, very important to remember, when it was a stock option, I just said, we issued these guys 1 million shares at a privilege price of 15. So they brought in 15 million. The market price per share is 20. But we gave them the privilege of buying them at 15. If they were to go to the stock market, they can't go to the stock market because these are employees. If they are to go to the stock market, they can only buy the shares at 20. So now that they brought in 15 million and you gave them 1 million shares, their 15 million should have been enough to buy how many shares in the stock market? It would be enough to buy only 750. We are getting that 750 by taking the amount received from the stock option divided by the market price per share. That gives you the number of shares deemed to be issued at full market price. Then the difference between the 1 million and the stock up and the market price, those issued at full market price, are the ones we are considering to be bonus. Once you separate that, go back to the rule. When shares are issued at full market price, they must be weighted. Multiply that by 6 over 12. It can be 9 over 12, 2 over 12, depending on when the company issued them. Of course, if the stock option was issued at the beginning, you don't multiply by 6 over 12. No. Then I've said, bonus, you know, they are never weighted. Why? Because they are assumed to be issued at the beginning. Then I told you, was stock option, because of the bonus, the EPS of the previous year should also be restated. I've told you, how do you restate it? By dividing the earnings of the previous year by the number of shares in the previous year, 2 million, plus the bonus element in the current year, plus the bonus share element in the current year. Good. That was bonus, a stock option. Now I've come to rights issue. We are saying, as much as it looks the same as stock option, there is a slight difference. The similarity is, you still must separate how many out of the 1 million shares are deemed to be issued at full market price, how many are deemed to be issued as bonus. To get the number of shares deemed to be issued at full market price, we have said you first calculate a price called the theoretical ex-right price. To get the number of shares deemed to be issued at full market price, we first calculate a price called theoretical ex-right price. How do you get that theoretical ex-right price? We have said you divide the market capitalization of the company after the rights issue by the number of shares after the rights issue. That will give you the theoretical ex-right price. I've said this is the price that is expected to prevail after the rights issue. Once you get that expected price in the market, now you ask yourself, these guys bought 1 million shares and they paid us only 15. So they gave us 15 million shillings. If they were to use their 15 million to go to the stock market, they will not find one share at 15. Of course, we gave them the privilege of buying them at 15, but we expect the price will be 18.3. So their 15 million would not be enough to buy 1 million shares. Their 15 million would only be enough to buy 819,672 shares. That is enough to buy that amount. Meaning the balance out of the 1 million, 819 is those deemed to be issued at full market price. That leaves me with the balance to my honor of how many? Of 180,328 to be the ones issued as bonus. Once you separate that, remember the rule. We have said those issued at full market price must be weighted on time basis. Yeah, they must be weighted on time basis. which is 6/12. Those issued as bonus are never weighted. Those issued as bonus are never weighted. Good. Then I've also said the EPS, because of the bonus element, the EPS of the previous year should be restated. The EPS of the previous year should be restated. How do you restate it? By multiplying it. By multiplying it. It means the EPS itself. By multiplying it by a factor. What is that factor? It is the theoretical ex-right price. It is the theoretical ex-right price. You divide that by the actual come-right price. You divide that by the actual come-right price. So whatever you get, that becomes the restated EPS for comparison purposes. Good. I think I'm through now with that issue of the rights issue. Now we go on to the next one. I hope you're okay now. So let's go to the next one. We are trying to remind ourselves of the key items just to compute what we are calling the weighted average, because it's the most complicated issue when it comes to earnings per share. Otherwise, if you can remember the rules of the weighted average number of shares, that means earnings per share or topic will be okay. Now, let's come to the next one. When shares are issued as a result of a share split. Now, our company began the year with 2 million shares. On 1st of July, our company, listen, our company split the existing shares, or in others, on 1st of July, there was a share split in the ratio of 2 for every 1. Now listen. On 1st July, our company did a share split of the existing shares. And they did a share split in the ratio of 2 for every 1. Tell me this. It means therefore from 1st of July onwards, how many shares will be in the register? We began the year with 2 million shares. Our company did a share split on 1st of July in the ratio of 2 for every 1. So it means from July, in the register, utapata how many shares? Somebody? In the register of shareholders, utapata how many shares? If we did a share split in the ratio of 2 for every 1, then it means from 1st of July, if you are to go to the register, you will get how many shares? Correct. Gilbert, you are right. 4 million. Correct. Somebody also called Ocheng. Correct. 4 million. Meaning, listen, meaning we issued 2 million on 1st of July. Listen to the ratio. We are saying we issued 2 for every 1. Our company did a share split in the ratio of 2 for every 1, meaning they issued 2 for every 1. If you are a shareholder, you had 1 share on 1st July, and your company did a share split of 2 for every 1, it means they issued 2 for every 1. So in the evening of 1st July, you as a shareholder who had 1 share, you will have only now 2 shares. In other words, they doubled your shares. So from 1st July, our shares will be 4 million. So it means we issued another 2 million shares. But the point is here now. Listen. Though we have 4 million shares from now on, listen. If our company had 2 million shares of shillings 10 each, sorry, it means our share capital was 20 million. Listen carefully. After the share split, the capital of the company does not change. The capital of the company does not change. It will still remain 20 million. But we have already said from 1st July, our company will have 4 million shares. So what will change? Listen, what will now change is the par value of your shares. So it means from now onwards, you will have 4 million shares, now not of 10 each, but of 5 each. You took a share of 10, you split it into 2. So you divided even the par value. So we are saying, the point is, when shares are issued as a result of a share split, the share capital of the company does not change. Listen, what we only do, we issue new shares of a lower par value. When we are issuing shares as a result of a share split, we just say new shares are issued of a lower par value. Of a lower par value. Now listen. Get the point? We did the share split on 1st of July. And I have told you, we gave the shareholders another 2 million. Did they bring anything to get this extra 2 million? No. We just did a split in the share company, in our company. We just did a share split of 2 shares for everyone. So it means, therefore, just like the stock option, just like the bonus, these guys never brought in anything. We just decided as a company, we want to split the shares of our company, just like we feel the market price of the company is too high. Sometimes companies find out that way, that the market price of the company is too high. So the only way to help members of public to buy our shares is to do a share split. So they reduce the par value of the shares, and automatically that means they reduce the market price of the shares. So I have said, when the company issued another 2 million shares, there was no money coming in. So we are concluding by saying share splits is the same way like bonus. They are treated as bonus shares. The way you treated bonus shares is the same way you treat the share split. In other words, not weighted. Not weighted on time basis. Not weighted on time basis. You don't come and say we issued an extra 2 million shares and therefore we multiply by 6/12 on 1st July. Why? Because no new funds came into the business. So one key point about share split is that they are never weighted on time basis. They are never weighted on time basis. They are treated like the bonus shares. They are treated like the bonus shares. Again, you see, listen, just like the bonus shares we have said, the rule said the EPS of the previous year should be restated. Assuming the earnings last year were 8 million, we divided that by 2 million, last year, we got EPS of 4. That should be restated. So you take the earnings last year, 8 million, listen, these 2 million shares that we issued at the beginning of, these shares that we issued 2 million on 1st July are assumed to be issued at the beginning of the year. So how many shares would have been there if the 2 million extra were issued on 1st January? Then it means there would be 4 million shares. So you divide that by 4 million, that means the EPS restated would be 2 shillings. Good. So just like bonus, share split, you treat it the same way. When shares are issued as a result of a share split, they are treated as bonus shares. One, they are not weighted on time basis. So you just say 2 million plus 2 million, you get the weighted average number of shares to be how many? 4 million. So whatever the earnings this year, just multiply by 4 million. Okay? You don't say 1st July 6/12. No. You issued another 2 million plus the 2 million that were there during the year, get 4 million. Don't weight them. They are not weighted. 2, the EPS of the previous year should be restated. How? By dividing the earnings of last year by, listen, by the number of shares after. By the number of shares after the share split. You can see after the share split we have 4 million shares. So we just divide that by 4 million, which is the same as saying take the number of shares that were there last year plus the number of shares that issued as a result of a share split. An extra 2 million were issued. That comes to 4 million. That comes to 4 million. Good. I think that's all I can say concerning share split. It's not hard. The same treatment like bonus. Never weighted on time basis. EPS of the previous year should be restated by dividing the earnings last year by the number of shares after the share split. Good. Now let me remind you the next one, and I think we are almost through with the key ones. The next one is when shares are issued on conversion. On conversion of debentures, stock preference shares. How do you deal with shares issued on conversion? Let me assume, again, we began with 1 million shares at 2 million. On 1st July, many years ago, we had issued convertible debentures. These debenture holders had not converted their debentures into ordinary or preference shares. We had issued convertible preference. They had not exercised their right for many years. Come this year, 1st July, they decided to exercise their right and converted their debentures into ordinary, and therefore we issued them another 1 million shares as a result of conversion. How do we use it? To compute the weighted average. Don't forget, we are trying to look at the rules for computing weighted average. What do you know? Listen, just to mention, there is only one rule. Listen, there is only one rule. When shares are issued as a result of, when shares are issued on conversion, maybe I can put it that way. When shares are issued on conversion of preference shares or preference shares or debentures into ordinary, the rule is they must be weighted. They must be weighted on time basis. They must be weighted on time basis. Listen, why must they be weighted? Remember, listen carefully. Remember, from many years ago up to now, these guys have been earning debenture interest. Or if they are preference, they have been earning preference dividends. So even for the first 6 months of this year, they are entitled to preference dividend. Or debenture holders are entitled to to debenture interest. Then, it is from 1st July that they will become my shareholders, called ordinary. They will become only shareholders for 6 months. So why again should I give you earnings for the full year when you're not a shareholder for the full year? And in fact, before that, you are already earning interest on debenture. Why should I give you earnings again for the period where you have already been earning interest? So in other words, we are saying when shares are issued as a result of conversion, they must be weighted on time basis. So you just come and take 2 million shares were there by the beginning plus 1 million shares times 6/12. That will give you the weighted average number of shares. That's the only rule you can remember, or you should remember, when it comes to issue on conversion. There is no other rule. There is no bonus here. So there is nothing to restate. No. You just know that these guys will be my shareholders for 6 months. I'll give them only earnings for 6 months. And after all, they were already earning something before that. The debenture holders were earning interest. The preference shareholders were earning preference dividends. So why should I give them earnings for a period when they are already earning? That's why we are saying they have to be weighted. Good. That's all. So I want you to remember that when shares are issued on conversion, they must be weighted on time basis. That's all for it. Nothing more. Next. And I think it's the last one. When shares are issued as a payment. When shares are issued as a payment of the purchase consideration. As a payment of the purchase consideration in a business acquisition. In a business acquisition. When shares are issued as a payment of purchase consideration in a business acquisition. Let me ask you a question. You are a holding company. You began the year with 2 million shares. You are a holding company. You began the year with 2 million shares. You acquired, listen, you acquired a subsidiary company. You acquired a subsidiary company on 1st July. You agreed with the subsidiary company as part of their payment of the purchase consideration, you will issue them shares. Listen, you issued those shares on 1st September. I have said you acquired a subsidiary company on 1st of July. You agreed with them that part of the purchase consideration will be settled by issue of shares. When you paid or when you issued those shares is on 1st of September. My question is, when I'm computing the weighted average, will I take 2 million plus? Maybe it's 1 million shares that were supposed to be issued. Will I multiply that by, remember there will be shareholders for part of the year. So it must be weighted. That's obvious. It must be weighted. Because they will not be my shareholders for the full year. We acquired a subsidiary in between the year. Had we acquired them at the beginning and we issued them shares that time, they would be my shareholders for the whole year. But here I acquired my subsidiary on 1st July. We agreed with them that the payment of the purchase consideration will be in form of shares, and we agreed with them I'll issue 1 million shares. But the only issue is I issued shares on 1st September. My question is, when I'm computing the weighted average number of shares, this 1 million shares, will I multiply that by 6/12 as from July, or will I multiply that by 4/12 as from September? In other words, these shares must be weighted from when? September or July? I want somebody to note there. That, remember we are revising. Shares issued as a payment of the purchase consideration in a business acquisition. Will I consider them as from 1st July, or will I consider them as from 1st September when I'm computing the weighted average? Good. Two people have got it. That is as from 1st July. Listen, you as a company, you incurred a debt on 1st of July. That's when you acquired that subsidiary. Though you paid your debt on 1st September, but the debt was incurred on 1st July. Listen, and after all, listen, after all, when you'll be consolidating with your subsidiary company, like we normally do in the income statement, you normally take the sales of the holding company plus the sales of the subsidiary company. But now, remember, this is your subsidiary company for 6 months. From the date you acquired, you will consolidate it, not as from the date you paid the purchase consideration. You will consolidate with them as from the date you acquired them, not the date you paid their purchase consideration. So you will normally take times 6 over 12 of their sales and blah, blah, blah. So in other words, we are saying when shares are issued as a payment of the purchase consideration in a business of acquisition, listen, the key point is they are considered as from the date of acquisition, they are considered as from the date of acquisition, from the date of acquisition, and not the dates, and not the date of the payment. Not the date of the payment. You consider them as from the date of acquisition. The reason is because the subsidiary's results will be consolidated from the date of acquisition, from the date of acquisition. So you will have taken 2 million plus 1,000 times 6 over 12 of the factor. So though you paid your share, your consideration in September, we don't consider them from the date of payment. The results being of the subsidiary will be consolidated from the date of acquisition, and therefore you also you consider them from the date of acquisition. So those shares which are issued as a payment of the purchase consideration in a business acquisition, they are considered as from the date of acquisition and not the date of the issue. Maybe we can even put it that way, not the date of the issue. Though you issued the shares in September, but we consider them from the date of acquisition. Like in this case, consider them from July. Good. I think I've summarized everything now. If you can be able to understand the rules of the weighted average number of shares whenever you're given circumstances. Now listen. Now before we do a question, remember some of your questions, we have done several in your past papers. The examiner normally gives you questions where several things take place during the year. Maybe 1st September, they issued bonus, 1st January or 1st February, whatever. So what is important as you keep computing the weighted average, keep remembering the rules. They issued shares at full market price. What have we said? They issued shares at full market price. What have we said? They should be weighted on time basis. That was one rule. When shares are issued at full market price, they are weighted. Multiply that by 6 over 12 or 9 over 12, whatever it is. That was the only point. We have also said when shares are issued at full market price, partly paid, only consider them to the extent that they are fully paid. Only consider them to the extent that they are fully paid. We issued 1 million shares, you remember, at a market price of 20, but these guys had only paid me 15. So I said they brought in 15 million shillings. Let me take you back. Here. They brought in 15 million shillings here. I said, this 15 million, if they were to go to the stock market, they would find one share being sold at 20. But we gave them the privilege of buying them at 15. Sorry. Not a privilege, sorry. They will still pay us 20, but they have so far paid me 15. Okay? Good. So, out of the 1 million, how many of them are considered to be fully paid? We said you take the amount received from the shares, amount received, you divide that by the market price per share. That will give you the number of shares to the extent that they are fully paid, or in other words, to the extent that they will participate in dividend. That's what we said. Then, of course, if they were issued in between the year, I told you must multiply that by the time adjustment factor. So the only rule for partly paid shares is they must be considered to the extent that they are fully paid. Out of the 1 million shares that you issued, how many of them are considered to be fully paid? How do you determine those which are deemed to be fully paid? Take the number of amount received from the rights from the issue, divide by the market price per share. From there we went to bonus, and I told you two rules for bonus. When shares are issued as bonus, one, never waited on time basis. Reason, no money came in. So you can't tell them that your money financed me for 6 months, so I multiply by 6/12. No, they are never waited. That was one rule. Why? Because they are assumed to be issued at the beginning of the year. Now that they are assumed to be issued at the beginning of the year, the other rule was the EPS of last year should also be restated. How? By dividing the earnings of last year by the number of shares last year plus the bonus in the current year. We had 2 million shares last year, more 1 million were issued this year's bonus, so you divide that by 3 million shares. That will give you the restated EPS. Good. From there we went to stock option. When shares are issued as a result of a stock option, what are the key important points? You have to ask yourself, out of the 1 million shares, how many of them are deemed to be fully paid? How many are deemed to be issued as bonus? Good. To separate, we have agreed when shares are issued as a result of a stock option, take the amount received from the stock option, divide by the market price per share. That will give you the number of shares deemed to be issued at full market price. Okay? The balance are the number of shares deemed to be issued as bonus. Once you separate, go back to the rules. Those issued at full market price must be weighted. Those issued as bonus are never weighted. Good. Then you have to remember, because of the component of bonus, the EPS of last year should also be restated. How? By dividing the earnings last year by the number of shares last year, which were 2 million, plus the bonus in the current year, 250. That gives us 2.25 million shares. Good. That was all for bonus, for stock option. Rights issue. We have said it's a privilege given to who? To existing shareholders to buy extra shares at a price below the market price. I've told you, you are issuing more shares in the market, you as a company. We expect the price of the shares to go down. We expect the price of the shares to go down. So we are saying when shares are issued as a result of a rights issue, again, some of them are deemed to be issued at full market price, some are deemed to be issued as bonus. How do you compute those which are deemed to be issued at full market price? We have said, first compute a price called theoretical ex-right price. How do you get that theoretical ex-right price? By dividing the market capitalization of the company after the rights issue by the number of shares after the rights issue. That will give you the theoretical ex-right price. Then to get the number of shares deemed to be issued at full market price, you divide the amount received from the stock option, which was 15 million. Don't forget that 15 million came in because of 1 million shares is what we issued at a price of 15 per share. That gave us 15 million. So that's how we got the 15 million. We divide that by the theoretical ex-right price. That will give you the number of shares deemed to be issued at full market price. Once you separate, get the balance as bonus, then you know the rules. Those issued at full market price must be weighted. That's what we have said. Those issued as bonus are never weighted. Again, because of the component of bonus, the EPS of the previous year should be restated. But I've told you, when it comes to rights issue, you don't restate it the same way you restated the stock option. No. For rights issue, I've said, whatever was the EPS of last year, that EPS of last year is to be restated by multiplying it by a factor. By multiplying it by a factor. What was the factor? It is the theoretical ex-right price. You divide that by the actual come-right price. You divide that by the actual come-right price. That will give you the restated EPS. Good. From there, we have come to share split. And I've said when shares are issued as a result of a share split, I have said more shares are issued of a lower par value. Of a lower par value. I say we are only changing the par value. We are not changing the capital of the company. I began by assuming we had 2 million shares at the beginning. Then on 1st July, we issued some shares as a result of a share split in the ratio of 2 for every 1, or whatever the ratio the examiner will give you. So if we are issuing 2 for every 1, then it means we are doubling. We are issuing 2 for every 1. It means we are doubling the shares. So from 1st July, you will now have 4 million shares, meaning it's like you're issuing another 2 million shares. But I've said from 1st July, our shares are no longer of 10 shillings par value. Our shares will now be of 5 par value. That's important to remember. We are not changing the capital. We are only changing the par value and the number of shares. I've also told you, because no money will come in on 1st July, then you treat the share split the same way you treat the bonus. How do you treat the bonus? They are never weighted, not weighted on time basis. Why? Because I told you no money came in to the business. Because of the bonus again, EPS of the previous year should be restated. How? By dividing the earnings of the previous year by the number of shares after the share split. Or in other words, by dividing the number of shares earnings last year by the number of shares last year plus the bonus that you gave this year. We gave another bonus of 2 million shares. That's why it's coming to 4 million. Good. That's all you can do. From there, we also reminded ourselves how to deal with conversion. When shares are issued on conversion of preference or debentures into ordinary, one rule only is they must be weighted on time basis. They must be weighted on time basis, because I've told you, remember, these guys were already earning. If they are debenture holders, they were already earning interest. If they were preference shares, they were earning preference dividend. So why should I give you earnings for the full year, yet you are already earning something before you converted your debentures into ordinary? So I only give you earnings for the period you became an ordinary shareholder. Like now, you will only be an ordinary shareholder for 6 months. I only give you earnings for 6 months. Good. That's why we are saying they must be weighted. Finally, we have said when shares are issued as a payment of the purchase consideration in a business acquisition, only one rule: they are considered as from the date of acquisition and not from the date of the issue. Why? Because I've also said the subsidiaries' results will be consolidated from the date of acquisition, not from the date of the issue. The day you acquired, that is when you crystallize, but not the day you are paying your debt. No, your debt, you incurred it on the day you acquired that subsidiary company. Good. I have no time to do a question now, but I want to believe that you have remembered the key rules, or you can now remember the key rules. So you allow me to stop there for today. We pick it up from there next time, where we shall now do first lesson. First, again, I remind you the key issues concerning what we call the diluted earnings per share. We have already said there are 2 types of shares: basic and diluted. So this one, I'll talk about it very fast. There are not many things concerning diluted. Once I talk about diluted, we shall now do past paper questions. Okay, so allow me to stop there. We pick it up from there next time. I remind you about diluted EPS. Then from there, we do questions on the topic of earnings per share. So diluted earnings per share is not much, because we already have some of the rules from the basic EPS. So I only talk about a few things concerning diluted earnings per share. Then from there, we shall do some past paper questions. Good. So maybe we can stop there. We pick it up from there next time. But before we do that, listen, before we do that, maybe I can mention this. Some of you are watching this through YouTube. So if you are watching me through YouTube, please, and you have not subscribed to my YouTube channel, please click that subscription button below there and subscribe to my YouTube channel. Please subscribe to my YouTube channel. Click that subscription button down there and subscribe so that you may be notified whenever we post new videos into the YouTube. You can also click the like button. I want to believe that you have understood something today and you have reminded something today. You have reminded yourself something today. So click that like button and like the video. Of course, some of you who are not in the YouTube, the name of the YouTube channel is called CPA Joseph Njuguna. So you can go there and watch some of the videos that we have them there. There are some which are there for promotion purposes. They are not all. They're just there for promotion. You can go there and watch some of the videos that we have posted there for promotion. That is in the channel called CPA Joseph Njuguna. That's the name of the YouTube channel. Now, again, listen, some of you have friends who would want to join our online classes. So tell your friends that we have online classes for the following subjects. 1, for the advanced financial reporting of the advanced level. Tell your friends that we have online classes for financial reporting of the intermediate level. We also have online classes for financial management of the intermediate level. And we also have financial accounting of the foundation level and the one of ATD1 and ATD2. So those are the papers we are currently offering for online classes. So if you are in need of any of them, then you can call me. If you are not able to join the live classes, you can buy what we call the pre-recorded videos. You can buy the pre-recorded videos where you can be able to watch the videos at your own free time, at your own pace. In fact, as at now, we have a special offer for the pre-recorded videos. So if you feel that you need to get the videos for the whole syllabus so that you can understand some of the topics, then you can call me. We talk about the pricing. Okay, so if you are not able to join the live class, you can buy the pre-recorded videos. I've said as at now we have a special offer for the videos. So call me on this number 0722 658875 0722 658875. For those who need the country code, it will be 254 722 658875. So click the subscription button. For those who are watching through YouTube, click that subscription button. I've said for those who are watching through Zoom and you would want to subscribe, go to the YouTube channel called CPA Joseph Njuguna and subscribe. You can watch some of the videos which are there for promotion purposes. I've said we're also offering online classes for these following subjects. 1, advanced financial reporting, like the one we are doing today. This is a topic for advanced financial reporting of the advanced level, financial reporting of the intermediate, financial management of the intermediate, and financial accounting of the foundation level. You can buy the pre-recorded videos if you want to get the concept of the whole syllabus or the topic for any of these 4 subjects. Good. Call me on that number 0722 658875. Good. So maybe we can stop there. I want to believe that at least you have understood something today. Somebody can put in a comment. Somebody is saying how much per class. Call me Shadrach. Call me on that number. We shall discuss. Call me on that number. We shall discuss. Okay. Any other comment before we close the class? I want to believe that you have understood something today, or you have reminded yourself. Maybe one comment before I close. I want to believe that you have understood something today concerning earnings per share. Is it correct? Put a comment for somebody. I want to see one comment before I close the class. Yes. I hope you have understood something today. Or in other words, you have reminded yourself of the topic of earnings per share. We thought we shall do a question, but we have discussed a lot. So I want to believe that today you have learned something or reminded yourself something. Is it okay? Is it okay? Can I close the class now? Unless somebody is putting a comment. Yes. So JK say yes. That means you have understood something today. Thank you. JK says yes. Thank you. Somebody called Oppo says thanks. Bye for now. Okay. See you next time. We shall do the next question in the next class. But for those who need the pre-recorded videos, call me on that number.